Hello, this is MrChris. Did you know that if the market crashes, a covered call ETF like ULTY or other yieldmax funds bought with margin could wipe out half your account, or even force you to sell at the very bottom? Covered call ETFs are famous for their big dividends, but what really happens to them in a crash? And why is it so much riskier if you bought them with margin? Let's break it down. Hello everyone, welcome back to the channel. In our last video, we talked about the September effect and why I stopped drip on ULTY to build more cash. Today, we're continuing that conversation by looking at what happens if the market really does crash, and specifically, how that impacts covered call ETFs like ULTY and other yieldmax funds when you own them outright versus if you use margin or leverage. But first, a disclaimer. Last year, I was forced to retire from my job, and so I bet my retirement income on yieldmax and options trading using the no-loss method of the wheel strategy. I'm not a financial advisor, and all content of my channel, including this video, are for educational, information, and entertainment purposes only. Please conduct your own research and proper due diligence before investing. If you like the content of my channel, please hit that like button, comment, and subscribe. I would like to find out how you generate your retirement income. Okay, let's go. A covered call ETF works by owning a basket of stocks and then selling call options against those stocks. The premiums from selling these covered calls are paid out as income to investors, and that is why these ETFs can generate such dividends. But here's the key point. While selling covered call options brings in steady income, it doesn't make the ETF crash-proof. If the market tanks, the ETF's net asset value will fall right along with it. The only difference is how much risk you take on, and that depends on whether you're using margin. Let's say you own a covered call ETF with no margin, just straight cash. If the market crashes, the value of the ETF drops. For example, let's say a 30% market drop. A 30% market drop could pull the ETF down close to that level. Distributions continue, but they will shrink because option premiums and stock dividends both get hit during downturns. The important thing is you are not forced to sell. You can ride it out. You may see your account value go down, but you are still collecting some income and you are still in the game waiting for the recovery. Now let us flip the story. Suppose you bought the ETF with 25% margin. This means that you borrowed money to increase your positions. If the market crashed, the first thing that would happen is that your losses gets magnified. For example, if the ETF drops 30%, your equity falls closer to 37 to 40% because of the leverage. Second, you are paying margin interest on top of those losses. In normal times, the ETF's dividends might cover it. But in a crash, when payouts shrink, the interest keeps eating away at your returns. And worst of all, margin calls. If your account equity drops too low, your broker can liquidate your shares automatically, and usually at the worst possible time. It's at the bottom of the crash, and that means you don't get to wait for recovery. You are forced out, locking in the loss permanently. Here's a simple example. Let's say you invest $100,000 into a covered call ETF and the market crashes. With no margin, if the ETF crashes 40%, your account drops to $60,000. It hurts, but you are still holding your shares and collecting smaller dividends while you wait for the market to bounce back. With a 25% margin, that same crash doesn't just take you to $50,000 or to $60,000, but because you borrowed your equity, the drop is closer to $50,000. Plus, you owe interest. And if the market keeps sliding, you might get a margin call, forcing you to sell everything right at the bottom. That's how leverage can turn an income strategy into a blowout. So here's the bottom line. Covered call ETFs like ULTY and other yieldmax funds can give you great income, but they are not immune to market crashes. If you own them without margin, you can weather the storm. Dividends may shrink, but you will still be positioned for recovery. If you own them with margin, losses are magnified, and income may not cover your interest, and you run the very real risk of being forced out at the worst possible time. That is why I personally avoid using margin with corporate call ETFs. The yields are already high enough. I would rather protect my capital and sleep well at night. So all of my ULTY shares and all the MISTIs, everything, I bought them outright. I do not use margin. So what about you? Would you ever use margin on a corporate call ETF, or do you stick to cash only investing? Let me know in the comments, and don't forget to like and subscribe. If this video helps you understand the risk better, please comment, and I'll see you in the next video. Thank you. If you like this video or any of the videos in my channel, please hit the like button and subscribe, and join me in my journey in generating my retirement income through trading options and investing in high yield funds like yieldmax. If you have any comment or question about the no loss method of the wheel strategy or my perspective about yieldmax, please write a comment and I will answer them the best I can. This is Mr. Chris. Thank you, and I will see you in my next video.